What just happened to silver should change how you think about trading price movements forever. Silver futures just closed at $63.33 an ounce, up nearly 9% month to date. On the surface, that looks simple. Price goes up, traders make money or lose it depending on their position. But dig one layer deeper, and something crucial reveals itself. We know what happened. We don't know why it happened. And that distinction might be the most important lesson in trading. Let's talk about what the data actually shows first. Silver opened this month at $58.16 an ounce. From there, it climbed to a high of $65.05. It never closed below $55.01 as support. That's a nearly 9% move month to date. In a commodity market, that's significant. That's the kind of move that gets attention. Traders noticed. Money flowed. The question is, why did that money flow? Here's where the honest research stops. Every major financial data source captured the price movement itself. Nobody captured the catalyst. That's not a failure of data. That's a feature of how markets actually work. By the time the public data aggregates a narrative around why something moved, the move has already happened. The traders who moved first were acting on information before the story crystallized. They had conviction. They saw something. Most people didn't. So what factors typically move silver? That's where we build a framework instead of relying on today's narrative. Silver is a precious metal, which means it trades like insurance. When investors get nervous about the economy, when they worry about inflation, when they fear currency debasement, they buy gold and they buy silver. It's a fear trade, and fear trades move with conviction. Fed policy is the primary lever for silver fear trades. If central banks cut rates or hold steady while inflation remains elevated, currency pressure intensifies. Weak currency makes precious metals more attractive to international buyers, because a weaker dollar means foreign investors purchase more metal with every unit of their home currency. More buyers equals higher prices. Conversely, when the Fed signals rate hikes or high rates persist, real yields rise, and precious metals become less attractive. The flow reverses. That's what makes Fed communication so powerful. Policy directly impacts the incentive structure for capital. Industrial demand is a completely different driver. It's not just about fear and inflation. Silver has real uses. Electronics, solar panels, medical devices, industrial applications. When manufacturing data comes out stronger than expected, when people are building more factories, deploying more solar installations, that creates genuine physical demand. It's not emotional. It's structural and persistent. And when you have fear-driven buying and industrial demand happening simultaneously, that's when 9% moves materialize. Geopolitical risk operates through the same safe haven channel. When there's tension in sanctions, conflict, political instability in major economies, investors move capital into assets perceived as safe. Gold and silver are ultimate safe havens. A single event can trigger significant reallocation. This month, we don't know which one dominated. We don't know if silver rose because the dollar weakened or because manufacturing picked up or because Fed expectations shifted or because geopolitical risk spiked somewhere and investors needed a safe haven. Maybe it was all four at once. That uncertainty is the blind spot. It's also where the money is. Here's what matters about this gap in understanding. If you saw silver at $63.33 today and thought, oh, it's up, I should buy it, you made a bet without knowing your thesis. You have no idea if you're betting on inflation fears or industrial strength or currency weakness. You have no idea how crowded the positioning is. If smart money already loaded up on this theme before the data crystallized, your entry is into strength that's already priced. You don't know what the reversal looks like. What happens to silver if the Fed stays hawkish? If manufacturing data softens? If the dollar rallies? You never asked these questions because you never asked why it moved in the first place. Professional traders work backward from price. They see silver up 9% and they immediately ask, did Fed communications shift this month? They pull FOMC statements, speaker notes, press conference transcripts. Did the dollar weaken? They check the US dollar index against major currencies. How much of this silver move is currency weakness versus real demand? Was there a geopolitical event? They scan for sanctions, conflicts, central bank moves. Did manufacturing reports come in hot? They check industrial production, purchasing manager indices, construction starts. They're building a forensic map of what actually happened. They're not guessing. They're reconstructing. They're not trying to predict the future. They're trying to understand the past well enough to know what they're betting on right now. That's the shift. Most traders see price and try to predict direction. Professional traders see price and reconstruct causation. Once you know what moved it, assessing whether that factor persists becomes tractable. Does it accelerate or fade? That's predictable. Price alone isn't. Causation is. That's the practical lesson here. Price moves don't explain themselves. A 9% jump is worth noticing, but noticing it after it happens isn't profitable. Understanding it is only useful if you understand it well enough to predict whether it continues or reverses. That's the work. That's the edge. Consistent traders profit from understanding drivers and assessing whether those drivers are accelerating or fading, not from predicting price. So the real question isn't why silver is up today. The real question is whether the thing that moved silver is still in effect. Is that pressure still there? If it was Fed expectations, are those expectations holding or shifting? If it was dollar weakness, is the dollar stabilizing or falling further? If it was safe haven demand, is that risk event still current? Is it building or fading? That's the question that separates traders who get lucky from traders who build consistent edges. Silver is at $63.33. It's up nearly 9% month to date. Those numbers are real. The story behind them? You have to find that yourself. The moment you stop passively consuming price data and start actively hunting for the drivers, your trading changes. You stop asking why something moved. You start asking whether it's moving for a reason that will sustain or a reason that will reverse. That's the difference. That's always been the difference.